Hey, investors! Ready to unlock the secret to tracking America's top companies? The S&P 500 is your go-to gauge for the US stock market. Picture it as the ultimate dream team of 500 powerhouse companies dominating the American economy. When people ask, how's the market doing? They're usually eyeing the S&P 500. This index is like a health check for the US economy, showing how the biggest players are performing. Since these companies make up a huge chunk of the market, the S&P 500 gives you a clear snapshot of overall market strength. Whether you're a Wall Street veteran or just dipping your toes into investing, mastering the S&P 500 is a must. So, strap in. We're diving into how it works, its upsides, its risks, and whether it's the right move for your portfolio in 2025. Let's roll. Curious about what makes the S&P 500 tick? Let's break it down. It's all about market capitalization, the total value of a company's shares on the stock market. Simply put, you take the current share price and multiply it by the number of shares out there. The bigger a company's market cap, the more sway it has in the S&P 500. That's why giants like Apple, Microsoft, and Nvidia can move the needle big time. This setup is called a market cap weighted index, meaning larger companies carry more weight. Think of it like a tug of war. The heavyweights pull harder. But it's not just about size. The S&P 500 isn't a random grab bag of 500 companies. A special crew at Standard & Poor's, S&P, handpicks them based on strict rules. These financial pros look at things like market size, trading volume, and industry balance to make sure the index mirrors the broader market. It's like curating an elite club. Only the best get in. The committee keeps tabs on the lineup, swapping out companies if they no longer make the grade, or if new stars rise. This constant refresh keeps the S&P 500 a real-time reflection of the US economy in 2025, capturing the latest market trends. Remember that tug of war? Let's zoom in on the heavyweights. In the S&P 500, companies with the biggest market caps, like Apple, Microsoft, and Nvidia, call the shots. Since the index is market cap weighted, these tech titans can push or pull the whole index. A stellar earnings report from Apple? The S&P 500 gets a lift. A rough patch for Nvidia? The index might wobble. This weighting system is a double-edged sword. It reflects reality. Big companies do matter more, but it also means concentration risk. If a few giants stumble, they can drag the whole index down, even if other sectors are thriving. In 2025, with tech still leading the charge, understanding this dynamic is key to navigating the S&P 500's ups and downs. So, how does the S&P 500 stack up against other major indices? Let's compare it to two big names, the Dow Jones Industrial Average, DJIA, and the Nasdaq Composite. The DJIA, tracking just 30 blue-chip companies, is like the old-school legend of indices. But it's price-weighted, so stocks with higher share prices have more influence, regardless of company size. Some argue this makes it less relevant in 2025's fast-moving markets. The Nasdaq Composite, on the other hand, is a tech-heavy index packed with growth companies. It's known for bigger swings, but also the potential for higher rewards. Which index wins? It depends on your goals and risk appetite. The S&P 500 strikes a balance. It's more diversified than the DJIA and less volatile than the Nasdaq. For investors in Tier 1 countries looking for broad US market exposure in 2025, the S&P 500 is often the sweet spot. But don't put all your eggs in one basket. Diversification across indices and assets is the name of the game. Before you jump headfirst into the S&P 500, let's talk about its blind spots. No investment is bulletproof, and the S&P 500 has its share of risks. First up, concentration risk. As we've mentioned, a handful of mega-cap companies, especially in tech, can heavily sway the index. If these giants hit a rough patch, the whole index can take a hit, even if smaller companies are doing fine. This can lead to sudden dips in your portfolio's value. Another catch? The S&P 500 is all about large-cap US stocks. That means you're missing out on small-cap companies, international markets, and other asset classes like bonds or real estate. For investors in 2025 aiming for a well-rounded portfolio, this lack of diversity can be a drawback. Plus, the market's unpredictable. Economic shifts, global events, or even interest rate hikes can shake things up. Past performance doesn't guarantee future gains, so don't bank on historical trends alone. Do your homework, consider diversifying, and maybe chat with a financial advisor to build a strategy that fits your goals. All right, you've got the scoop on the S&P 500's pros and cons. Now, the big question, should you invest? It depends on your financial game plan. If you're after a straightforward, low-cost way to tap into the US market, the S&P 500 is a solid pick. It's a benchmark for a reason, with a track record of steady growth over time. But don't ignore the risks. Market swings and volatility come with the territory. For 2025, with economic uncertainties like inflation or geopolitical tensions in play, a long-term mindset and clear risk tolerance are crucial. Ready to dive in? You've got two main paths, index funds and ETFs. Let's unpack both so you can choose the best fit for your portfolio. One of the simplest ways to invest in the S&P 500 is through index funds. These funds are built to mirror the index's performance, giving you a slice of all 500 companies in one go. Think of it as buying a basket of stocks without the hassle of picking them yourself. Index funds are loved for their low fees and no fuss approach, perfect for busy investors in Tier 1 countries who want to keep things simple. A standout option is the Vanguard 500 Index Fund, VFINX, a low-cost favorite that's great for beginners and pros alike. In 2025, index funds remain a go-to for steady, long-term growth. Want more control? Check out exchange-traded funds, ETFs. Like index funds, ETFs track the S&P 500, but they trade on stock exchanges like individual stocks. That means you can buy or sell them anytime during market hours, unlike index funds, which are priced once daily. ETFs offer real-time transparency and flexibility, making them a hit for active investors. The catch? They might come with slightly higher fees. A top pick is the SPDR S&P 500 ETF, SPI, a highly liquid fund that's a staple for S&P 500 exposure. In 2025's dynamic markets, ETFs give you the agility to react to changes fast. We've covered the S&P 500 from top to bottom, how it works, its strengths, its risks, and how to invest. So, should you take the plunge? There's no one-size-fits-all answer. It hinges on your goals, risk tolerance, and time horizon. Are you chasing long-term growth or quick wins? The S&P 500 can be a cornerstone of a diversified portfolio, offering access to America's top companies and solid potential for growth. But markets are wild, and even the S&P 500 can hit rough patches thanks to economic shifts or global events. Before you invest, do your research. Know your risk tolerance. Consider talking to a financial advisor to tailor a plan to your needs. Investing is a long game. Stay patient, keep learning, and build a portfolio that can weather 2025's ups and downs. With the right strategy, the S&P 500 could be your ticket to a brighter financial future. Stay sharp, stay invested,